Okay, we are now Cash and Internal Controls, Chapter 8, Part 2. We're talking about petty cash, system of control. Small payments required in most companies for items such as postage, courier fees, repairs, and supplies. What this is talking about is that typically there's a lockbox in somebody's office or in somebody's desk or somewhere for small payments that need to be paid. Sometimes people will run through petty cash like a lunch, or buy some candy, or postage, or just little things that come up that you just need such a little amount you don't want to go through the whole process of getting everything approved and spending the cash. But you still need to have control over it because you don't want just everybody going in there. So that's why there's a lockbox, typically. So operating a petty cash fund, what you need to do first of all is you need to write a check to establish it. You take that to the bank and you get cash. So you write that you're going to debit petty cash and credit cash. Then you have, in this case, it's $75. You're going to take that $70, put it in the lockbox. Every time somebody does something, you're going to put you're going to have a note, a petty cash note, saying, here's the receipt for this. We had to get some office supplies, so it's office supplies for $4.52. And we have postage for $30, whatever. So all of a sudden all of a sudden your cash gets down, right? So when your cash gets way down to the point, Daisy, stop. Gets way down, and you have to replenish it, then that's when you're going to record the entry to record those, because otherwise they're not actually getting recorded. So every time you make a payment, you have to have some kind of a thing to help you. And when you get low on cash, then you're going to replenish your supply. It's only used for business expenses, nothing else. So you could use it for transportation in, services, supplies, or delivery charges. So, petty cash receipts with either no signature or a forged signature indicate there might be misuse of petty cash funds. So when you're replenishing your supply, so as you can see here, they've got miscellaneous expenses that happen on November 2nd. They got the cleaning of LCD panels, $20. Tire cleaning, $26.50. Transportation, $15.05. Package delivery, $5. Office supplies, $4.75. So they use $71.30. So we have to record that somehow. So when we make the entry for that, if I can actually flip these pages because I'm not very good at that, we're going to make an entry then for $46.50 to miscellaneous, $15.05 to merchandise inventory, $5 to delivery, office supplies expense $4.75, and then cash. So that check, in essence, is just replenishing our cash supply, our petty cash fund. So that way, everything gets recorded to the proper accounts, and we've handled the whole situation. Having trouble today, can you tell? And it's not the end of the chapter yet. Okay. How's that? Nope, we're not in focus anymore. How's that? Hope you can see that okay. Basic bank services. You have bank accounts, signature cards, deposit tickets, checks, electronic funds transfer, and bank statements. On your bank statement, usually once a month, the bank sends each depositor a bank statement showing the activity in the account. And in the bank statement, it'll list all the checks and debits. That would be electronic transfers, NSF checks, whatever happens. Any charges they might charge would be listed separately, and then their deposits are listed separately along with EFTs, and then they'll run a daily balance and showing you an ending amount. think all of you have seen a bank statement, so you know what they look like. For those of you who don't do bank reconciliations, we're going to discuss them. A bank reconciliation is prepared periodically to explain the difference between the cash reported by the bank statement and the cash balance on customers' books. So you're going to take your bank balance per your statement, and you're going to compare that to your book balance. And you're going to find out what checks that you wrote out of the books haven't cleared, what deposits haven't cleared, and if there's any fees or EFTs, deposits, or automatic debits that have not been recorded in the books. So you have to make sure that you've got you're doing both sides, because there's stuff on the book that may not have been in the book or on the bank statement that may not be recorded in the book yet, like banks, if there's any fees or anything like that that you don't know about. So you have to make sure that you book those, so then you can get the differences. So you're going to have your bank balance, you're going to add and deduct any outstanding checks or deposits. And if you may need to find some errors, because sometimes you write a check out for $150 and they clear it as $120. Well, that's an error. So you have to reconcile that. So you always have to make sure you check that the amount that you wrote the check for is what actually cleared the bank. Same thing with the book. Here's your book balance. You have anything that didn't tie out to anything that wasn't included in the books that was on the bank that you have to put in, you need to list that as well. Here we go. The balance of a checking account reported on the bank statement rarely equals the balance in the depositor's accounting records. I don't know about you, but I check my balance quite often, and I make sure that I subtract off all of the checks or electronic funds that I know are coming out of it to see what my cash actually is. So I know exactly how much money I have in my bank pretty much on a daily basis, just because I want to know for sure. If I have something coming up that I need to pay, that I want to make sure that I have the funds for it. Or if something unexpected happens, I have the funds for it. Or I know if I have the funds for it or not. Okay, so the cash balance per bank, you have to add the deposits in transit, minus the outstanding checks, plus or minus the errors, whichever way it would be. That equals your adjusted cash balance. For the cash balance per books, you're going to add any interest, because you may have earned some interest on your account. There's not many of those accounts left, but there could be. Subtract any uncollectible items, plus or minus errors, and that equals your adjusted cash balance, and the two should agree. Adjusting entries are recorded for the reconciling items on the book side of the reconciliation. So if there's any differences in the amount the checks cleared, or if there's any fees or any interest income, we have to record that as an adjusting entry for our bank, for our bank accounts, to make sure that it's cool. Okay. For a bank reconciliation, sync again. Okay. Follow 9 steps. There are 9 steps in preparing the bank rec. I don't see 9 steps. Do you see 9 steps? Second. Okay, so we have 9 steps. It's in the next couple slides. Okay, first step is you get your cash balance per bank. You are going to find out what deposits have not cleared, and then you're going to find out what checks haven't cleared, and then make sure that you found any or discovered any of the discrepancies between the two, and that would be your adjusted cash balance. So that is your first 4 steps. This is just not working very well, is it? It was working so well earlier. Okay. Your next 4 steps are, you're going to compare your cash balance per books for any collections or interest that you may have earned, your uncollectible items, and any errors, whichever way it went, and that's going to be to your adjusted cash balance. And then your last one would be comparing the two. So you're going to have the two different aspects of that bank rec and make sure that they come down and they actually agree. So then you have to record your adjusting entries. That would be your 9th step. Record the reconciling items for the book side of the reconciliation. So only the items reconciling the book balance require adjusting. So the first entry here we have is to record the collection fees and proceeds for a note collected by the bank. So if the bank did any collections for you, you wouldn't have known about it until you saw the bank statement, and then you could record it. The next one is to record interest earned on the cash balance of the checking account. The next one is the check printing charge, so any service charges that you get charged. And the last one is to charge the Woods account for an NSF check and a bank fee. I think that NSF fees are a lot higher than that, but what do I know? I don't have those. Okay. Global view. Internal control purposes, principles, and procedures. The purpose and principles of internal control system are fundamentally the same across the globe. Control of cash. Accounting definitions for cash are similar for U.S. GAAP and IFRS. The bank activities as controls. There are global demand for bank services, bank statements, and bank reconciliations. To the extent feasible, companies utilize bank services as part of their effective control procedures. Days sales uncollected indicates how much time is likely to pass before we receive cash receipts from credit sales. So you take your total accounts receivable at the end of the period divided by your net sales, not your gross sales, your net sales, multiply that by 365, and that's how many days it takes for your sales to get collected. Okay? So if we look down here, our example, the first one for Hasbro, they have an 88-day turnaround, and for Mattel, it's 73 days for 2011. Sorry, there you go. Appendix 8A, documentation and verification. I've lost it here. Purchase requisition, purchase order, invoice, and receiving report. So what this is talking about is when we place a purchase, when we want to buy something, we make a requisition. So we send that to our purchase department saying we want to order this. They verify that's what you need, and they place the order. Once they place the order, then we get an invoice from the company saying that they've accepted it and that they're shipping it. And then when we actually receive it, we get a receiving report, so we'll have 4 pieces of documents for each of those purchases. And way back when I did, when I had my own company and I would go into accounting or companies and look at their accounting system and see how their flow was, this is something I would spend a lot of time on because I did a lot of manufacturing companies, making sure that all the paperwork got together before they released things and paid things, so that everything made sure that we got it there. We had enough documentation to make sure that everything was done correctly. Control of purchase discounts. The net method gives management an advantage in controlling and monitoring cash payments involving cash discounts. When purchases are recorded at net amounts, a discount lost expense account is recorded and brought to management's attention. So what this is talking about is, you know how we set up our entries for purchases, You debit your inventory account and you credit your accounts payable. And then when you make payment, then you take your discount and record your discount. Well, there's one school of thought is that instead of doing that, if you're always going to take the discounts, then instead of doing that, you're going to just record it net automatically. So you're going to show on your first transaction, you're going to show the purchase net of the discount and the net amount as your accounts payable. So when you make the cash payment of it, it's just cash and then take it directly out of accounts payable. There is no separate entry for it or separate line item for it. But if you miss it, then that's when the discount lost expense account is used to record that. And yay, we are at the end of chapter 8. Thank you.